We're back in class today. Oh man, this is going to be my favorite lesson that we've done so far. So it's good to see all of you guys here. Oh yeah, we can do a little screen digital fist bump. That'll work. That'll work. So let me ask you guys. Let me ask you guys. Do you feel like you're learning something? Do you feel like do you feel like the price of tuition is worth it?
100%.
Very good. Because listen, you can always get a refund, a full money back guarantee. If you don't love OVTLYR University, we will refund your tuition 100%. Manny was just asking, where's JC? He was here like 10 seconds ago and he dropped out. I don't know. Maybe he's having a computer issue, but that's all right. We're going to cover some really, really cool stuff today. So
probably on vacation from all that money he made, Chris.
Let's go. Let's go. That's what I'm talking about. All right. So today in OVTLYR University, we're going to be covering risk management and position sizing. More ultra boring stuff. But you know what? We got to get through the boring stuff so you understand what to do when we start putting on trades, right? You probably got in here thinking this would be a 9-week course, and you'd be like, dude, this is going to be so easy. Chris is going to teach us what to do in the first week, and then the other 9 weeks are going to be sitting on our hands, right? No. You've got to learn how to do this, right? Let's say you wanted to go play football. I played football from 7th grade until I was a senior in high school. I talked to a couple colleges about maybe playing football there, but I also played in the band. And there's a lot to learn. And as you go, you get more experience and you learn more things as it's going. And by the way, this is American football, which is the only football. Everything else is soccer. Just putting that out there. Now, once I got to them, I talked to a couple colleges. I played center, and I was pretty good. I was academic All-State. I was academic All-American. I knew what I was doing, but I was about 8 inches and 100 pounds at least too small to play. So I was like, I'm going to go join the band. So I went to school, played in the band. That's where I met my wife. So everything worked out that way, right? That worked out that way. But with it being band or with it being football, you've got to understand how to do the plays. You got to understand how to read the music. And we're trying to translate this into all the different things, right? You don't just show up on day one and get a band scholarship. You don't just show up on day one and get a football scholarship. There's a long way to go to get from A to B. There's JC right there.
Hey, JC. Sorry, guys. I tried to get in with my desktop and it wouldn't. Bullshit.
No,
so I had to go on with it's all good. Sorry.
Awesome. JC, we're going to be covering probably my favorite lesson so far, so I'm really excited about it today. All right, so let me introduce myself real quick, because as a random guy on the internet, you probably should want to know who I am. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. Now, we're going to get to Lesson 8, risk management and position sizing, but let's go over the homework real quick. What did you guys think of the homework? If you don't mind, raise your hand so I can call on you. But what did you guys think of the homework, right? We had to do all those flashcards. There were a whole bunch of them. I know that was a lot of work, but Mike, having gone through all that now, what's changed?
I was surprised how actually I didn't miss any, which was awesome to me. Yeah, I just surprised that I was waiting for the trick question or something, but it was a lot, but I didn't miss any, and I thought, well, I must be heading the right way. There was a couple. Oh, I know one thing. I have a note. I want to ask you about that.
Oh yeah,
creating internal reward systems. I was curious, like, what is that? Like you, Chris, like you. I figured you created those questions, so instead, it said that was a good thing to do. It was
Mike, what did I tell you I did after I made those 6 days worth of trades a couple weeks ago?
You bought a watch.
You bought a real nice watch. I know that.
Batman.
This is true. Now, I looked it up. I didn't want to mention it on stream, but thanks to Ferdinand this morning, now everybody knows.
I looked it up.
But I paid off my wife's student loans.
Yeah.
There you go. That is a internal motivator, right? It made me feel good to do that for her. And I treated myself a little bit too. But at the end of the day, it was only because I had followed my plan, only because I was profitable did we get to that point, right?
I took that as something else. I remember you telling us that, but I was thinking it was more of a psychological, something you conditioned yourself. There was so much psychology in those questions. I thought I was kind of thinking it was all about that. So
Yeah, for sure. For sure. All right. Anybody else? I think Ozzy Ian had his hand raised.
Yeah, no, I went through it with my wife, and we sort of sat there, and it was great because she sort of gets it now, and she confirmed everything that we were talking about. There was just one that I did get wrong, and it was just about the position size being large. And I thought that if you had a large position size, then your game would be larger. But I got that one wrong. So
Well, it can be,
yeah.
but
I mean,
it can
you
also
couldn't
be
win
very
big.
detrimental to your account, right?
Yeah, but it needs to be proportional to your account. So
Exactly.
Yeah,
Very
that
cool.
one spoke to me too, Ozzy, because it just said huge position size, and I'm thinking, well, if it's a huge position size, I'm probably going to make a ton of money with OVTLYR, right? But if you're thinking risk first and making sure that you're going to be there for the next trade, it's an appropriate question to consider huge position size being detrimental to your future. So yeah, that other than that, it just really spoke to me, that question.
There you go.
Good
That's
question.
great. So we learned a lot last week, or last time, just on Tuesday. But like the trading psychology aspect must be overcome, right? You've got there, and there's so many different things that you've got to overcome to be successful as a trader. And I'm telling you, that's why 90% of traders blow up 90% of their accounts in the first 90 days of trading, because they cannot do what we do. In order to be successful, you have to do the opposite of what everybody else is going to do. Thankfully, those of you here in class, those of you here live, and those of you who are going to watch the replay, we are giving everything to you. There's nothing I'm holding back. But you can't do a strategy, you can't do entry and exits unless you understand yourself and can overcome those natural human tendencies. You can't be successful and be just like everybody else. It's not going to happen. Success doesn't happen on accident. I love that quote. Now, let's talk about risk management. How would you guys define risk management? Who would want to go first? I'm going to call on Deep Thought.
Pretty much anything that will stop you from hemorrhaging money if a trade goes against you.
Yeah.
So that you end up with small losses instead of those big losses that we don't want. We just want the small losses.
But who cares about losses? I'm here to make money.
Everyone's going to have losses. It's probability. So there's nothing you can do. You may as well just try and at least manage them.
But if my strategy is set up perfectly, if all outlier 9 are lit up, I can't possibly lose, right?
So of course you can.
Then what's the point of having outlier 9?
It just swings the odds in your favor so that you're more likely to have a win.
So if all the odds in my favor, then I should just, put on the biggest trade size possible, right?
No, definitely not. Not a good idea.
Why?
Because once again, down to position sizing, that's part of your risk management. Make sure that if you do have a loss, the loss is only going to be tiny.
Look at that. Look at that. We're learning something, right? These are the questions that you're going to ask yourself. These are the questions that peers are going to ask you, maybe even your wife, if you're hanging out with Ozzy Ian's wife, which I think is awesome that she's actually interested in trading. I've told y'all before, when I talk numbers, my wife just glazes over like a donut. It like she can see it coming before it comes out of my mouth, and she's already zoned out. Like it's like instinctual. Joe, what was on your mind?
Part of the struggle for a new trader is you ask a question on YouTube, right? Look at this particular stock, and to you, it's just some candles, and maybe you don't even know they're candles, right? But typically, the response you get is, "Well, what's your plan?" Well, you have to start from something. You have to have some kind of guardrails to lead you into a direction to even begin thinking about, is this stock something I should be investing in, right? And for me, that's part of one of the foundational things that OVTLYR gives you is these things most likely are going to lead to a successful trade. If you follow these things and then make adjustments from there, including things like risk management, you'll probably be here in a week. Right? You'll make it to day 91. But as a new trader, you're just watching videos and some fella is telling you chase it on the way down because it's got to go up. Well, if you have no plan and no way to make a plan, you're going to do that because it sounds great. It's going to go bang up, right? But yeah, Position sizing is what keeps you in the game for day 91.
We should get a coin.
Such a great answer.
We should get a 91-day coin.
91-day coin, like an AA thing, right?
Yeah, I made a 91 days of trade. I like the 91 day.
I think it was Ian who said something like outliers actually make 90% of their accounts the first 90 days of trading, right? I wish I could give you that stat. I really wish I could give you that stat, but we can't make that promise like that. What's up, JC?
Is there a real study, or is that more like a saying based on truth, but not really 90-90-90?
I know for a fact that this is something that brokers build into their business plan. Let's ask real quick.
I looked into it, and there's no statistical ever study that's been done, but it's meant to really portray a truth, which is most of the people blow most of their stuff pretty early on, basically.
Well, there's no formal academic study,
right?
But there is data to support the spirit of the rule.
The spirit, right?
CFTC report from not all that long ago, so it's not like 1980 to 1984.
Right.
70 to 80% of retail traders lose money over 12 months, averaging between $3,000 and $10,000, depending on the broker. A French study said 89%.
I'm the mean.
Dude, yeah, exactly. So I told you the first time I blew up my account, I consider it blown up at 67%. And I was talking to, I forget who I was talking to, but they're like, dude, you are actually doing way better than everybody else. If you kept 60, a third of your account, that's still way more than blowing up 90%. I was like, oh yeah, I guess I did.
Wow.
So I, chalk up that to a win, I suppose. But okay, let's continue on with this lesson here. We got a lot to cover, and I'm very, very excited about it. Risk management is the single. Oh, go ahead, Paul.
I did a chat GPT search, and the Europeans actually keep a stat, and I believe they said 75% of their contract for difference traders lose money. So that's a real life stat.
Yeah. I mean, it is real, right? It sounds unbelievable, and it's a nice, easy rule of thumb to consider, but this is what we've got to overcome. If you can overcome this, you're going to be successful. Now, risk management. This is the single most important aspect in all of the math of trading, right? The math of trading. You can come up with anything you want to, but if the math doesn't math, it doesn't matter. For me, risk management is making sure that I've limited my downside potential. And the goal every day is that when you have money in the market is to, you've heard me say this before, reduce risk. Before taking any trade, your number one goal is look to reduce risk. Reducing risk means rolling up options. It means taking off trades that aren't working. You must be looking at where you can reduce risk every single day before putting on anything new. And that's one of the reasons we do what we do. This is the opposite of how most people enter the market, right? That's the opposite. They aren't looking to reduce risk every day. They're actually looking to say, how can I make more? How can I put more risk on in the market, right? If this trade worked out, the next one has to work out. So I'm going to double my risk, right? Or I'm going to be putting on as many trades as possibly can fit inside my portfolio. I did that. I told y'all the story of when I was on a business trip, got in the back of an Uber, had no trading plan whatsoever, had my iPad, and I was just like, sell this, sell this option, sell this option, until I had completely put my whole entire 100% portfolio at risk in 30 minutes with no plan. And then I proceeded to lose my ass on all of that. And I had no business doing it like that. No business doing it like that. But yet that's how a lot of people get into the market. They're like, I have to do something, so let's go add some more risk today. And that's why 90-90-90 happens. So Larry Hite is one of my mentors. He is the very first billion-dollar hedge fund manager, one of the original market wizards, super cool guy. And one of his quotes is, I have two basic rules in winning, rules about winning in trading as well as in life. If you don't bet, you can't win. If you lose all your chips, you can't bet. That is all about risk management right there. Meaning, if you want to play the game, you're going to have to take risk. But if you've taken so much risk that you can't play anymore, you're out of the game. You're out of the game. So learn to take a loss. When I worked with Larry Hite, it was about 3 hours. And he basically said this for two of the 3 hours, just over and over and over and over and over. Learn to take a loss, learn to take a loss, learn to take a loss. And listen, it got really boring by the 71st time that he said it. But it was such an important thing that's why he kept drilling it over and over and over. Now, my goal is to help you save time, make money, and start winning with less risk. And it just takes 3 easy, itty-bitty baby steps. Head on over to OVTLYR.com, pick up the annual pass for just 82 cents a day. Or if you're on the monthly plan, you can upgrade with just 1 click, and that'll get you access to the OVTLYR 9. And then step 3 is sit back and relax. You just found the easiest way to save time, make money, and start winning with less risk. There we go. So now, speaking of less risk, let's talk about risk here. Avoiding big losses. So let me move this out of the way. A 10% loss requires an 11% gain to get back to break even. Okay. Some people can start to conceptualize what that means. A 20% loss requires a 25% gain to get back even. Some people might understand what that means. But this is where people's brains break. A 50% loss requires a 100% gain to get back to break even. And a 90% loss requires a 900% gain to get back to break even. So let's break down what this means. This is where people break right here. A 50% loss. Imagine you have a $100 stock that goes down to $50. That's a 50% loss. To get back to $100, you need to double. That is a 100% gain. Let's go look at a chart. Probably can think of the chart that I want to go look at. AMD. Let's see. Where was it down 50% from its highs? Let's see. Let's say we start right here and let's go down. I don't know. Let's say about right here, right? That's a 50% loss from here to here. How much does it take to get back to that point, right? Because somebody bought it right here. For a fact, somebody bought it right there. They might even still be sitting on it. So to go back from here to here, that's a long way, isn't it? To go back from here to here, let's move this line over here. That would take, come on, clicky. Here we go. That would take a 100% gain. We see this? A 100% gain. A 50% loss takes a 100% gain to get back. A loss from 220 down to 111, 110, it now has to double to go from 110 to 220. Losses actually work against you exponentially more than winners do. It's huge, right? A 50% win, like think you're a genius with a 50% win when you came off the back of a 100% loss. Think you're a genius at a 50% win. You're only halfway back to break even. 50% loss, 50% win. That 50% loss towers over the 50% win. Isn't that crazy? This is why people can't handle it, right? They're like, oh, it's just a 50% loss. So I didn't realize I had to double to get back to break even. And then 900% is or 90% is even worse. So remember, we still haven't placed any trades. You've got to understand all the rules before placing the trades, just like playing a game, right? I got ahead of my slide there earlier. But let's look at a couple other things from Mark Minervini, one of my mentors. Based on the feedback I'm hearing, it seems traders are more fearful of missing a great buying opportunity, aka FOMO. There's way more FOMO, fearful of FOMO than they are of volatility and more downside risk. Amateurs are concerned with missing out on the upside. They focus on the money. They hate to take the losses or sell too early. They focus in on, I'm going to pay this off. I'm going to buy this nice watch. I'm going to do this thing or that thing, rather than the risk that they're taking in the market. Pros focus on managing risk, implementing processes, and maintaining the discipline needed to consistently execute their plan. Not saying consistently win, not saying consistently buy Lambos, consistently execute the plan, knowing that if they get those right, the money takes care of itself. Right? This is a huge nut shot, I guess, if you want to call it that, to most people out there, because they don't care about risk. They don't care about the plan. They just want to make money. And you're not going to make money unless you care about risk and unless you care about the plan. They work together. You have to have a profitable plan, and we'll show you how to do that in a little bit. Next, another slide for Mark. If you're not doing well in trading stocks, the grand majority of the problem is ego driven, like we talked about just the other day in trading psychology, is ego driven by fear. The problem is you, which means the solution is you. That's the agency we talked about. That's what the psychologist and I talked about, the agency of the fact that I can solve this problem. But first, you have to accept responsibility and banish the blame. Then you become empowered with the ability to respond. Now, this slide here, I wanted to show because it's when you get into a trade. Let me see if I can make this bigger. Yeah. When you get into a trade, right, you buy it here and it goes up and then it comes back down. And you know that you should get out. You know you should get out, but you're afraid that it's going to turn around and go up without you, right? That's happened many times, and that's part of the game. You cannot predict what is going to happen. But what you can predict is that the path of least resistance, when it's starting to move against you, is more downside, And then you're left wondering, why does this keep happening to me? Because you caused the problem, which means you can be the solution. So remember, do you remember the back test we ran, right? One of the homework assignments I asked you to do is work on some back tests, come up with a plan. I want to see how those numbers played out. So a few of you guys sent me some data, and I want to share that with the crowd. So first we'll go with Paul. Paul shared these numbers here, and he told me that these are actually my numbers. He told me these are my numbers. I didn't realize that they were, but I was like, cool, let's run with these. I legit did not know these were my numbers. So on these that he was following here, the win rate was 50%, which on the whole, you're like, 50% win rate, that's nothing, right? But let's look at this. Average win, 66%. Average loss, 22%. So your average win, in this case, Paul, was 3 times bigger than your average loss with a win rate of 50%. Now let's run the math on this. This is a really cool spreadsheet that I'm not sharing with anybody except the alpha group. Sorry, I'm because of some conflicts. This is just something that I'm sharing with the alpha group. But 50% win rate, $66 to win, right? 66%, $66. It doesn't matter. We'll just put 66. And the average loss is 22.98. We'll just round that to 23. Okay, so negative 23. So our inputs are 50% win rate, 66% win, 23% loss. You can do this in dollars. You can do this in percents. It doesn't matter, right? You could do this at 6,600 or 2,300, 66,000 or 23,000, whatever the case is. Numbers are going to number. Math is going to math. The expectancy here is positive. Okay, the expectancy here is $21.50. So for every trade that Paul would put on, actually it would be 21.50 in percent. So 21.5% is the average gain. Now let's run our simulations here. This is going to run 500 different simulations of 365 trades. Okay, so a buttload of simulations. We're going to let that run. We can see it working down here at the bottom. And our objective here is to make sure the absolute worst case outcome is profitable. So look at this. Look at this. $5,000 with just $66 for wins, $23 for losses. $5,000 is the absolute worst case scenario after 365 trades. I would say that's a pretty damn good worst case scenario. Would you guys agree with me? Yeah, legit. Worst case scenario with just $66 in wins, $23 in losses, and a 50% win rate over 365 trades give you a $5,000 account. How cool is that? Now, best case scenario is $10,000. And we can fall probably somewhere in between those 2 points at 7,800. This is really cool. This is super cool. That is a fantastic strategy. And it's almost like I know what I'm talking about because I didn't even know when Paul sent me these numbers that they were mine. Now let's go to another one. This is from Brad. Brad was showing us his numbers here, and he has a win rate of 40%. We'll type that in here, 40%. He's got the average win of 81.89. So we can even do this in big numbers here. 81.89. Okay. Big numbers here. And let's say his average loss was 25.86. We have to do a negative minus 25.86. Expectancy, $1,700 just to start, right? Let's run our 500 simulations of 365 trades. This is working down here. Brad, how would an extra $370,000 in the worst case scenario sound? In the worst case scenario, Brad.
Yeah, I mean, seriously, that's just it's one thing to think about it and do your theories and stuff like that, but when you see it run over a course like that, it's unreal. Just following
It changes the game, doesn't it?
Yeah, absolutely.
This is why I had you guys work on a plan. This is why I had you guys work on backtesting, because once you see the numbers, it changes everything. The heavens look down. The heavens look down on us and say, wait a minute. This is awesome. Now, Dave sent us 2. Let's run Dave's 2. Let's see. Dave sent me his one he called 1025. And this is a 43.1% win rate with an average win of 540, average loss of 641. So let's say 540 and 641. All right. Expectancy right off the bat, it's not looking good. Negative 131. So let's run this. Now, of course, this is why we do this, right? We are looking to find out if the math validates the strategy, if the math backs up what we hope is going to work, right? It's one thing to come up with the plan. It's one thing to backtest it, but it's another thing to play out. How does this actually play out here? This is not great, right? Now Dave, he sent 2, so I'm glad, right? Because in this strategy here, worst case scenario is negative $82,000. And also notice, best case scenario is negative $17,000. Mm-hmm. This ain't good. This is not what I'm trading. No way. I wouldn't buy this with your money, Dave. No way, dude.
I wouldn't either. I wouldn't either. Now let's go look at the other one that actually is a strategy I've created.
Let's go look at the other one.
Yeah.
So this is
first strategy was a simple one.
This is one Dave calls the Dave Wave. And I really like the name. It's a great name. It's a tremendous name. It's an incredible name. If Joe Biden had that name, he would probably be president right now. But let's take a look at this, right? So 72.1% win rate, 467 average win, and 167 average loss. You can see right off the bat, this is bonkers. Run the simulation. Theoretical expectancy. So for every time Dave would put the trade on, $209. And of course, scale that to whatever you want to scale. Worst case scenario, 93,000 profit. 93,000 in profit. Best case scenario, 127,000 in profit. Somewhere in the midpoint puts us right around 105. This is a tremendous trade right here, Dave. I love it. This is fantastic. Yeah. And this is what we try to figure out. Where are these numbers coming from? They're coming from Dave finding a strategy, testing a strategy, and coming up with the real numbers. Mm-hmm. Cool, right? So like I say, you can do this in percents. You can do this in dollars. Doesn't matter. The goal here is to see, okay, if I run this, what are my expectations here? What is the expectancy we talk about? Now, yeah, let's all put hashtag Dave in the chat. Let's all show Dave some love. I like that idea, Joe. Very cool. The Dave Wave. Now, I want to share with you a couple other scenarios. I want to share with you my numbers because I'm just a random guy on the internet. I don't know what I'm talking about. If we go here, this is my 2024 results. I had a 69% win rate, 69.39. My average win was only 1897. My average loss was negative 1790. So my average win to average loss last year wasn't all that great, right? Pretty close to each other, 1790 and 1897. So we're just going to use big numbers here, 1897 minus 1790. So I have a positive expectancy. Run the simulations on this, and it comes to worst case scenario, positive 183,000. Best case scenario, 382,000. And I'm telling you, once you get the math and you can follow your plan, you can have numbers like this. This is why we backtest. I'll share with you another number. Let's do our 2025 results so far. Now, I've only placed 12 trades, so the data here is not very good. If I had 120 trades, so 10 times more than this, I would feel the results are way more realistic. But this is all I've got to go on so far. So win rate, 58%, not all that great, 58.33. And average win, 51.42. I'm not going to be able to remember both of these, so we're going to type them in real quick. 51.42. And then average loss was 21.52. Run that. Positive expectancy right off the bat. Almost done. Now it's done. Way better than last year. And I'm telling you guys, when the worst case scenario is making $578,000, you're doing something right. When the worst case scenario is big profits, you're doing it right. Now, let me run a couple other scenarios for you. I really want to show you this. So this is what it was like when I sold options. I had an 84% win rate, but my average win theoretically was $100. So if I had a $10 wide call credit spread, put credit spread, whatever the case is, a $10 wide option spread, and the most that I could make was $100 here, and I had an 84% win rate, my average loss in the trade would be $900. You can see right here, expectancy is not looking good to start off with. Let's run our simulations. And this is why I couldn't make money trading options. Wait for it. This is why I couldn't make money trading options. The math was never going to work. The best case scenario was me still losing trades, me still losing overall. That's the best case scenario. Now, this is not uncommon for options trading. Now, another thing that I actually did to make it worse was, you know what? Getting that full $100 in this case, that full $100 is so hard to come by because you got to wait till the absolute end of expiration. So let's say that I took 50% of that. Let's say I took 50%. I still have the same amount of risk, but is it possible to use the inverse of this strategy? Yeah, it's called the OVTLYR 9 and the golden ticket trading strategy. Yeah, it's exactly that. So I still have the same amount of risk, but now I've cut my potential profits in half. I still have an 84% win rate. This is going to be brutal. And this is what Chris dealt with for years, thinking I was a genius. The best case outcome was losing $19,000. This is the most realistic thing I've seen all day. The best case outcome for me was that. But in reality, it was more like this. In reality, it was more like this, thinking that I was a genius over and over and over. This is how Chris blew out his account twice. This is how Chris lost over $200,000 trading options. Was this. Exactly. What you see on the board right here is what happened to Chris. Yeah, this is a great way. Let's call it the grave digger. Now, I heard, it's a rumor. I'm not going to disclose where the rumor comes from, but I heard a rumor that there are people on the internet who say that you shouldn't take half. You should take a quarter. You should take a quarter of the potential profit. So $25. Still the same amount of risk. Let's even bump up the win rate. Let's say you had a 90%. No. Let's say you had a 95% win rate. I've heard people on the internet that his name starts with a fee and ends with a licks, might do something like this. I don't know. Just rumors. So running this situation here. Look at that. You might actually turn a profit, but you have to be right 95% of the time. And if you're wrong, it's toast. I mean, legitimately, how many trades does it take to make up for one losing trade over here? So 900 divided by 25. It would take you 36 perfect trades in a row to make up for one loser. You think that's going to work, guys? Do you think that's solid risk management right there? No, absolutely not. Absolutely not. But isn't this cool, right? Putting the math together, being able to see and conceptualize and say, okay, my expectancy is X. You know, what does that mean to me? It could mean that you have a strategy that's so sound that even the worst case scenario makes you tons of money. Isn't that cool? that cool? So that's why I wanted to share that with you guys and why I wanted to go through all those different scenarios there. So if you want to get to the point where you want to get to the point where the worst case scenario is still profitable. And once you've hit that point, you've proven with data and you can follow that plan, it's game on. It's game on. Let's go to the championship all day, every day. Now, if it's not where you have profitability, even your worst case, these are the three things you need to work on. How can I increase my win rate? Right. So as you're going through your strategies, testing them, improving them, making ideas, new strategy improvements, enhancements, whatever the case is, figure out how can I increase my win rate? How can I increase my average win? And how can I decrease my average loss? Those are the three things you need to be working on, right? And if that means adding in market breadth, if that means adding in sector breadth, if that means adding in a different indicator, whatever the case is, how can you improve one of these three, two of these three, or maybe even all three of these three? But the most important one is how can I decrease my average loss? This will pay more than the win rate or the average win. Next, how do we control risk? How do we control risk, right? Because once we get into the trade, once we get into the market, we're no longer in control of it, right? The market's going to do what the market's going to do. So for example, if we go to Tesla, it's down 15% today. Tesla is getting absolutely, I haven't got to use this in a while. Tesla has gotten absolutely, it's been a minute since I got to use that. Tesla has gotten absolutely monkey hammered today. Now, if you were watching Tesla, you saw 1, 2, 3 closes underneath the 10 EMA before this happened. Before this happened, right? You had a warning. You had warning, and then it happened. So anyway, looking at this, once you're in the trade, you can't choose what the market's going to do, but we can choose when the market's going to take us wherever it's going, so long as we choose to stay. Right? If we are holding on to this trade, we are choosing to just let the market do what the market's going to do. We can choose to hold it over here, or we can choose to hold it down here. Right? We choose, right? We have the control of when we get in and when we get out. It's a big deal. And if you don't get out, you end up in a situation like this. You end up in a situation like this. So we have two tools for risk management. And these only work, and these are not the two tools. These only work if you have a trading plan and you figured out how you can follow that plan. Everything's working sequentially here. The two tools are, number one, position sizing, and number two, your stop loss. These are the only two things that you have at your disposal once you're in the market. Position sizing and stop loss. Both can be calculated automatically for you. This is my formula for position sizing. Now, I got this from the Complete Turtle Trader book, as well as working with Steve Burns, and it makes so much sense to me because you take your account balance, you're dividing it by how much risk you're willing to take, and then you're multiplying by how much risk you're willing to take, and you're dividing it by 2 times the ATR. Now, if you guys remember what ATR is, that's the volatility of the stock. And the volatility of the stock is not the same between all stocks. It's not even the same day to day. So that keeps you on top of it, knowing I can make my strategy fit what the market is telling me right now versus I'll just buy 100 shares of stock of whatever. This is a risk-based measurement for sizing. It's not portfolio-based. It is not capital-based. Capital-based. Come on with the I. It's not capital-based. This is a risk-based sizing. So let's look at a couple examples. This is from our option sizing spreadsheet, which you guys have access to out in our Discord. Now, the formula here, taking your account balance, multiplying it by your risk percent, and then dividing it by 2 times the ATR gives you the number of shares. So I put on several different names here. I tried to find some boring stocks and exciting stocks. So Palantir's exciting, Coke's boring, Tesla's exciting, Amazon's kind of boring. And then I was like, what's super boring? How about US Steel? That's super boring. Now, looking at these, we can see the ATR value, the volatility is very different between these, right? Tesla is 10 times as much basically as US Steel. And Palantir and Amazon are actually pretty close together. And you can see the share sizing here is vastly different between these, vastly different, right? We're looking at this and we're saying, okay, for the same amount of risk, I could buy 392 Palantir shares or 2,240 Coca-Cola shares or 157 Tesla shares or 400 Amazon shares or 1,500 US Steel shares. Now, let's say that you want to trade options. I like to use the 80 delta, but you can use whatever delta you want. You just take this share size and you divide by your delta to get option sizes, okay? Now, next, notice you keep the risk consistent. You cannot keep your position sizing consistent. Your risk is still the same 1250 on each one of these, and I'll explain that in just a minute. The risk is still the same 1250. Remember, that's coming from this formula right here. Your risk is still the same 1250. But your position sizing is all over the place, because these stocks behave differently. You need to make sure that you position size differently because of how they behave. All of these have the same risk, but the ones with higher in ATR have a lower position sizing. For example, Tesla has the lowest position sizing, 157, because it has the highest ATR. Coke has the lowest ATR and has the highest position sizing. And we are having consistent levels of risk amongst all of these. This is your risk management we're talking about here, okay? Remember, all stocks are bad. That's one of my quotes. And I don't think enough people understand. All stocks are bad. Every stock out there wants to take your money. But only every once in a while do they act right. So we need to treat it as if the stock was behaving correctly, we got in, but then it's still a bad stock and it can still take your money. So we need to make sure we position size and we treat risk appropriate here. So looking at this, what I was saying earlier is you're like, wait a minute. If I say I have a $100,000 account and I'm willing to risk 5% of that account per trade, that means I would have a $95,000 account if all goes wrong. But yet the total risk here is $1,250. How can that be so? It's only a quarter of that risk. That way, if shit goes sideways, you can still have a terrible exit and you still have not maxed out your risk at 5%. This is by design. If it gaps down, if something goes wrong, if you can't get to it until later in the day, whatever the case is, it is by design where the worst case scenario is 5%. But if you can get out the half ATR, which nobody can ever get out the half ATR, then your total risk is limited to this. Pretty cool, right? It's by design trying to get you out of the way and have less risk. Now, it's not a bug, it's a safety feature. So this, like I said earlier, is risk-based measurement for position sizing, not capital or portfolio-based. Now, notice another thing over here. Notice the sizing percentages, because I know somebody in the chat's already been like, wait a minute, how can that be? How can I have a trade in Coca-Cola that's 159% of my account? That makes no sense at all. Where in the wide world of sports does this random guy on the internet come up with ideas like this? This is taking your current value and then subtracting it from the half ATR, right? What's that difference here? What's 7120 minus 7064? 7120 minus 7064. I did it wrong. 7120 minus, I almost did it again, 7164. Good gravy, come on. 44 cents. 44 cents times your position size gives you the amount of risk you're willing to take. So I would bet you if I multiply that by 2240, that would be, give or take. I did something wrong, clearly. Doesn't matter. Point is, I fudged somewhere on the numbers here, but that gets you to this number here. Now, if you take the price of the stock times the share size, price of stock times the share size, that's going to give you $159,000 in this case. $159,000. That's more than my account, my friend. That's way more than my account. Chris, how can you come up with these crazy ideas? if I'm only going to let it go down, I have to get this right. It's driving me nuts. 7120 minus 7120 minus 70.64, 56 cents. There we go. 56 cents times 2240. It's almost like I know what I'm talking about every once in a while. And clearly I needed a couple of extra keys to get it right. 1250. Okay. So if this size is that huge, can you really trade it? Can you really trade it? Probably not. But it's only going to cost you that much of your account if it goes from 7120 to 7064. So you can put on monster positions. What's up, Joe?
Let's say you did trade it. And I'm asking this because I have no idea about margin. Let's say you did trade it and you took advantage of margin. You'd have to pay some sort of interest rate to your broker. Is that right?
That's true. So if you are, brokers will allow you to go, it really depends, but some brokers, let's just use an example here, will allow you to go 100% over what your deposit is. So let's say you had $100,000 at your broker. You could actually buy, depending on the broker, $200,000 of stock. Sounds cool, right? But first off, you doubled your risk. Second off, if you do that, the value of how much you went over, how much you've deposited, that extra $100,000 is now subject to a margin rate. And that margin rate can vary. I mean, I've seen some that are 10%. So now, if you hold it for a year, you've got to make more than 10% to break even on that margin. So it sounds great. Like I can trade with twice as much, but there are definitely downsides to it. It's not a free ride here. No way, my friend. Good question, though.
So definitely don't use margin to buy SGov.
No, because you'll lose money on it.
Yeah, exactly.
No, I mean, because SGov's paying like 4% or something, give or take. Right. And if your broker is charging you 10%, this is a losing arbitrage. You can't overcome that. Nice. So let's say that we took all of these trades. That'd be 439% of our account. That's huge. However, if we traded options, and I priced these out earlier today, so these are good numbers here, around the 80 delta, that would be 6% of my account to trade Palantir versus 50%. Hold on a minute. That would be 7% of my account to trade options versus Coca-Cola at 159%. This is too good to be true. It would take 4% of my account rather than 48% of my account to trade Tesla? Whoa. So you're telling me I could put on all 5 of these trades and it would be only 39% of my account versus putting all 5 of these trades in stock for the same position size, basically, and it'd be 439%. That's crazy talk. That's crazy talk. But when you trade options the correct way, this is how you can do it. And I can put all 5 of these on. Whereas if you're buying stock, you might be able to get 2. You might be able to get Palantir and Tesla, and that's it. So this actually reduces your risk tremendously. Tremendously. Because you are putting on a size equivalent to the a share size right here. Equivalent to that. Yet it's only 7% of your account versus 50%. Isn't that cool? Yeah, go ahead, Joe.
But not only are you reducing your risk by the right sizing, but you're also reducing your risk because you're buying a contract, you're buying a long call. So the most you're going to lose is what you paid for it anyway.
Exactly. The very most you can lose is the price of the option. That's it. So by trading options, we have significantly reduced our market exposure. Market exposure meaning if I put money into the market, it's now at risk. And if I put 48% of my account into Tesla, 48% of my account is at risk versus 4% of my account at risk. And I'm going to have nearly the same outcome. Man, I love options. They're so cool. And we haven't even started talking about them yet. So a couple things to keep in mind. The tighter your stop, the bigger size you can go. The looser your stop, the smaller size you need to take. Meaning, if you're wrong, how much are you going to give it to find out if you're wrong? Right? The further away you let it run, the smaller size you need to take. But in my opinion, you want to find out if you're wrong as fast as possible. Right? A winning racehorse doesn't back up into the gate. And that's why the half ATR works so great. Is if I'm right, then it's gonna I don't know what Dave, what would you call that when you've got your flaps down or whatever and you start the takeoff?
As far as what? As far as, I actually like your analogy that a winning horse doesn't back up from the gate. They want to go. Exactly. I actually really like that analogy.
Well, there you go. We'll stick with that one. A winning racehorse doesn't back up into the gate.
Exactly.
But if he does, that's fine. Just take that horse to the glue factory and go get a new horse.
Exactly.
What's up, Mikey Mike?
I can't remember what the trade was, but I remember that you had you recommended bailing out at the drops below the 10 EMA. You had your half ATR in there, and on that particular trade, you were talking about if it goes below the 10 EMA. So I'm trying to figure out when you go with one over the other.
You can go both. Like let's use Tesla as an example, right? Let's say that I got in right here, and the ATR value of Tesla at this point in time was 1793. So let's do 1793 divided by 2, 890. We'll call it 896. So 896 below that price, 318 is 309.03. So let's put another line up here. 309.03. There we go. We'll work with that. So in this case, your stop loss is the half ATR, right? I'm only going to find out if it's working by this much. And you can see that trade would have worked, right? Now your trailing stop is one that goes up with you, and that would be the blue line, the 10 EMA. So the 10 EMA runs up with you, and then you can find out and get out here. So let's use that. Mike, this was a great question. You can get out here versus all the way back down here, right? All the way back. If you never moved your stop, this would be the place where you'd still get out.
Okay. Yeah, I couldn't remember how it was connected, but I remember I can't remember what the trade was either, but
that's okay. That's all right. So yeah, I mean, if we're following the 10 EMA, that's the trailing stop. The green line is where we got in. The half ATR is our stop loss. And then the blue line, the 10 EMA, would be your trailing stop, because that trails up the whole way. And then you'll know if it stops going that way, right?
Okay. Yep.
Good question, though. Looks like JC's trying to join us twice. There we go. He's still there. Okay, we're making it, JC. So on risk percentages, I trade at 7%. I trade at 7%. I don't want to skip ahead. Hang on. I trade at 7%, meaning if I'm wrong, the absolute worst thing that can happen is I lose 7% of my account. Now, that is actually huge. Doesn't sound huge, but it is enormous. That is not portfolio size. That is risk size. Do not trade at 7%. I'm just putting that out there right now. Do not think that you're ready to trade at 7%. Do not even think about trading at 7%. If you really think that you can trade at 7%, I got another thing coming for you. You're about to get slapped by the market so hard. I've been doing this since 2009. I understand my risks. And I'm going to show you exactly how big of a difference it is to go from 5% to 7% in risk size. That's not portfolio size. But what I would say is start at 1%. Now, Mike, I think this is a great example because you mentioned this the other day, right? You were at a smaller percentage, and then you went up on one, and that just happened to be one that was a loser. You couldn't control that, right? The distribution of wins to losses, it just happened to land on the losing side versus on the winning side. And now that sucks, right? Because you're like, oh man, I did something wrong. But really you didn't. All you did was position size. So starting at 1%, then bump up to 2.5% and get comfortable with these sizes, right? Get comfortable with what that loss looks like. Get comfortable with what that win looks like, right? And then bump up to 5%, right? So stair step it up, okay? Now here's the deal. Don't even think about going over 5%. Don't even think about going over 5% until you are consistently making money. Don't even think about it, but take your time to go up to here because it's going to feel really different. Like you're going up 2.5 times the amount of risk, which means your losses are going to feel 2.5 times as hard. And then you're going to go up another double. So it's going to feel twice as hard to go from here to here. What's up, Joe?
So what does consistently making money look like? Like if you go back to your public portfolio sheet,
yeah.
What of those numbers would say, look, I am consistent?
That's a great question. That's a really good question, Joe. I think you're going to have to figure out where that is, right? I wouldn't say it's one single trade, but I wouldn't also say that you need 7 years to figure that out either, right? If you can come out, let's say 6 months, if you can consistently trade 6 months profitably, then maybe it's time to bump up that position size. If you can,
almost wonder if it's not just profitably, it's also beating the S&P, right? Because I could just park it there and make 9% or whatever.
Yeah, I hear your point. But really, it really comes down to personality and risk tolerance, right? If it still hurts at 1% when you take a loss, probably shouldn't be going up to 2.5. If you get to 2.5 and you're like, okay, I can handle this. It's just part of the game. I know what I'm doing. Then maybe you're ready to go up to 5%. But that's really subjective. I really can't tell you trade this long at this level. Yeah. Because like what happened to Mike, it could be that very first trade you put on at that bigger level that goes against you. And you're like, oh God, that was not what I wanted to see. Mm-hmm. But it can absolutely happen.
I like your idea with the 6 months. Because like you said, Tuesday, I think you mentioned your first 7 trades could be losers, and then your next 3 could be massive winners, right?
Yep.
But you're probably not going to see that in 1 week. You need to give it some period of time
exactly
to prove out your plan.
Yeah. Dave, were you going to say something?
Yeah, I just wanted to make a comment too. Look at your risk tolerance as your maximum. In other words, if you take a trade that doesn't feel right, maybe you say it's a stock that's not an outlier. You don't have the extra validation, confirmation. Maybe you should reduce your risk down. Your A+ setups, man, that's the ones that take your maximum comfortable risk, but offset them. I know I trade a lot of futures during the day. Man, in the morning when I got liquidity, yeah, I'm all in. Not all in. I'm at my maximum risk, my comfort level. When I lose liquidity during the day, if we have a big movement, I start risking down. I'm not going to take the same risk at, noon Eastern time that I'm going to take at, 9:30 or 10 a.m. because the liquidity has changed. The behavior of that instrument changes. And, that's something to keep in mind. It's not a static number. Change it based on the conditions, but it's a maximum until you're really comfortable.
Yeah, I like that. And let's say, for example, you would do 100% of your risk, 100% of 5% when outlier 9 are lined up. But let's say for every one of those that isn't working, you could scale that back by 1/9, right? So maybe it's 4% if it's 8 out of 9 and 3% if it's 7 out of 9 or something like that. That's totally doable, right? You need to figure out for you and your plan how to set up. But I like that idea, Dave. That's really good.
If you were going to run a test like that, Chris, and do backtesting, would you do, I guess, a couple of different Excel sheets that you were just showing us with the portfolio manager to kind of show if I have 8 of 9, this is my sheet that tells me this is my win rate. Anytime I have 8 of 9 lit up green, versus if I have 9 of 9 green, this is my other sheet that gives me my win rate.
Dude, for sure. Yeah. And that's going to give you confidence at both of those levels. And at the end of the day, the confidence is what we're trying to build here, right? Because you need to know if I'm putting this money in the market, I'm confident that I have set myself up in the best way that I possibly can. And if I'm wrong, because it's going to happen, I'm confident that I can keep that loss small. That's the important part. All right. Let's go to this. I wanted to show you guys what it looks like to go from 5% to 7%. So top one up here is 5%. Bottom one down here is 7%. Right? It doesn't seem like much, but that's going from option size on Palantir of 4 to 6. That's 50% more. 50% more. Okay. That's going from option size of Coke at 28 to 39. That's about 30% more. On Tesla, it's going from 1 contract to 2. That's 100% more, right? And these are just tweaking it from 5% portfolio risk to 7% portfolio risk. And you can see just actually how far that goes. So, like I'm saying, don't trade at 7% until you're ready. Now, the percentages don't feel like much, but because of position sizing, I just showed you a couple examples, right? 50% more on Palantir, 30% more on Coke, 100% more on Tesla. Yet the risk is, honestly, it's not very much at all. But the position sizing is that much bigger. So do not trade 7%. Do not trade 7% unless you know what you're doing. I think I saw someone in the chat say, unless you've earned the right to go up to the next level, right? It's like leveling up in a game, right? You don't start at level 7. You need to start level 1. Get comfortable at level 1, master at level 1, then go up to level 2, then level 3, etc., up to 7. Now, my 7% risk, it's not an accident. Actually, I worked with Mark, our chief strategist, and he's like, Chris, this is where you want to be. This is the optimal size to maximize risk or maximize profits, minimize risk, and be able to have enough trades on concurrently, right? Because in you've seen that the way that I trade, it's a short window. It was 6 days last time. I made bank in 6 days. And now I sit and I wait, and I sit and I wait, and I sit and I wait. And there's going to be another 6-day period where I'm going to make bank again. But I have to sit and I have to wait. I have to wait. I have to wait. So if I had 25% and I could only take, 4 trades, then I could be losing out on a ton. If just one of those trades goes sideways for me, then I'm toast. But at 7%, that allows me to put on multiple trades. That allows me to find the right level of risk and maximize the profits there too. So it was really, really cool. Mark and I had a good, we had several meetings trying to figure out that. And if the smartest man I know sat down and told me the most I could trade is 7%, I'm going to listen. Joe, go ahead.
Yeah, Patrick in the chat brought up a point I had kind of forgotten about with the Turtle Trader book, where they mentioned once you get on a losing streak, reduce your risk level until you get your confidence back. So that could be a good point.
That is a great point. In fact, there was a point in time I had built a little formula thing in my position sizing where if I lost a trade, it would subtract a decent amount from my my risk. Like, so if I lost a trade, it'd go from 5% down to 4.5%. If I lost another trade, it'd go from 4.5% to 4%, to help me make sure I didn't go on tilt, right? To get that revenge trading or anything like that. And that's totally something you can do. Absolutely. But going from 1 to 5 and then 5 to 7 right away can lead to serious issues. Winning at 1% and then your first trade at 5% can really feel like you did something wrong when you still followed your plan and you still would have ended up in the same place. In reality, you followed your plan, you just sized up too quickly. Nothing personal, Mike, but I really am glad that you shared that with us. That's a big deal, right? It's a big deal.
Yeah, it went over real well at home too. So
get something thrown at you. How could you have gone up 5%?
You idiot. No, actually, it wasn't too bad. It just sucked. But yeah.
Okay, great question from Paul. So I used the Kelly criterion in my results, and it gave me 25%. So Kelly criterion, don't even go Googling it, because it was developed by a casino gambler, and he figured out the optimal position sizing. And when I did the math, it came out at 25%, which is then when I contacted Mark and I said, Mark, Kelly criterion says 25%. What do you think? And he's like, yeah, I don't know about that. So that's where that came from, actually. So I'm really glad Paul asked that question, because I've gone down that road. Last couple slides here. Trade management would also be considered risk management, right? That's when you're reducing your risk every single day. When you're moving up your stops, when you're following your trailing stop, when you're rolling up options, all of that is part of risk management. And remember, the two things that you have in the market that you can, your two safety nets are your position sizing and your stop loss. Once you're in the market, that's all you got working for you. Okay. Now, some homework. I want you to take your back tests and start plugging them into that spreadsheet I gave you in the Discord. I shared it in our alphas group over there. Start refining your plan so that the worst case scenario is still profitable. So next week, I want to see your results and I want to see your plans. Okay. This doesn't mean it has to be perfect, but I want to see how you got to these points, right? Maybe when the 10 is over the 20, price is over the 50, maybe just that alone is your exit signal. Or maybe just an outlier buy and sell signal, right? Just give me something. I want to see how you have refined your plan. And it doesn't have to be your final plan set in stone. It could be like Dave showed me today. He was trying 2 different ones. One worked great and one was terrible. That's okay. There's nothing wrong with that. Being a trader is being okay with being wrong. And then figuring out how to do it better and better and better as you go. So what questions do you gentlemen in class have? And if you are watching live, you can ask some questions as well. Just do me a favor and type #Q followed by your question. That way I'll be able to see it. So gentlemen, what can I do for you? What questions do you have? Go ahead, Deep Thought.
There's just 1 or 2 questions that I saw from some of the comments in the chat. One of them was about options using, basically because of your delta in options, how that goes against you if you start to lose a trade versus risk if you're losing compared to stocks.
Okay, check this out. When you are in an options trade and it's working for you, your delta is growing. So let's say, for example, that I bought this option here at the 78 delta. As it goes deeper into the money, it goes from 78 to 81 to 82 to 89, right? It's moving up. My option's getting bigger, which means it's getting more valuable. As it goes the opposite direction, if I start losing, the delta actually contracts and it loses less as it gets worse. Isn't that cool? Right? That's that change right there is called gamma. But it in a nutshell, the more it's working for you, the more profitable it gets. The less it's working for you, the less it hurts you. It's crazy, but that's how options are priced. It's really cool. Delta's growing with gamma. Exactly. Were there any other questions you guys saw in the chat, or maybe some questions you have? Go ahead, Dave.
I just want to throw out a quick deal here. Deep Thought and I have both gone through and created risk spreadsheets, position sizing spreadsheets for TradingView and Thinkorswim that are available in the Discord and the corresponding tabs, just to help everybody out calculate this. So,
dude, brilliant.
There are some extra tools out there specific to those trading platforms. So.
Dude, don't we have the best students in OVTLYR University? Y'all are awesome. You guys are really sweet. Okay, let's see any questions that came through here. Bobby's World. What do you do if your trade is working, but you're running out of time? So for me, I have a rule that 1 week before expiration, I don't work. I mean, if you're worried about time, oh, I went way too far. If you're worried about time, the first thing to do is roll the option out, right? Roll the option out if you can. If you're already profitable and it's got to 1 week before expiration, then you can keep it on. If it's not already profitable, then go ahead and close it now. Right? Don't worry about the time. Go ahead and close it now. If you are already profitable and you can roll out and up for a credit, out for sure, maybe up and out for a credit, then yeah, keep it and roll it out. But if not, go ahead and close it now. Right? Try not to put yourself in a situation where you are worried that you're going to run out of time. If you're running out of time and it's not already profitable, it's probably not going to happen. Probably not going to happen. Patrick, is the OVTLYR University Discord folder just for the Alpha group? We do have a private chat just for the Alpha group. However, most everything we put in the Alpha chat that you can see. And I drop everything into the OVTLYR University announcements section. So yeah, go check that out. You should be good to go. I try not to keep anything behind any walls, but that one spreadsheet, I just don't feel comfortable sharing that out there. Morgie, I'm from the GB, and I've had many small profits turn into a loss when I sold due to the exchange rate of the falling dollar. Should I find UK stocks or would options help? You know, that's a great question. I've never had to deal with an exchange causing an issue. My thought is, you know, just go with what you feel you have the most profitable opportunities for, right? If the, I mean, if your trades are only profitable where a 50 basis point move on the exchange rate is going to make you negative, maybe your trades aren't as profitable as you think they are. I mean, in reality speak, if your trades can't handle a small change in the underlying currency valuation, it's probably not a very profitable trade to start with. So you might want to work on updating your strategy to find a better profitable strategy. That's honestly, I know that's probably a little tough love there, but that's what I would be working on. Chi Wing Yu. Does trading in a paper account give you a good indication if you leveled up? I'm guessing mostly only half because the emotional part's taken out. I think that is, everyone should start with the paper account, right? Build that paper account as if it were real, right? Get used to it. Get used to the buttons you click, the position sizing, all the legwork that goes into putting on the trades. Get used to it in a paper trading account. Then after you've proven you're profitable in that trading account, and that's not one trade, that's multiple months of trading. The second time I blew up my account, I spent 6 months trading like it was going to be the last thing I ever did. And that's what made me profitable. So work on that. Work on being profitable in your paper trading account. Then when you do get to real trading, start with 1%. It's going to be way less than you're used to. And that should be easy then. It should be super easy. And then start bumping that up as you get more profitable, as you get used to those position sizings. What's up, Brad?
So when you're first starting out, could you build into your plan a like only trade options that are under a certain ATR? So if it goes against you, you don't get crushed right off the bat. You know, a slower ATR, yeah, it's going to take longer to make any money, any moves, but at least if it goes against you, it's not, you can actually get in there. Because, you know, looking at that Tesla, if you traded that Tesla and you went out to lunch and you came back and that thing is gone, you know, that could destroy you. But a smaller ATR, like you said, like the Coke or whatever, if it makes a move against you, you have a little bit more time to react. As a new trader, that would be great. Would you encourage that?
I mean, if you're getting used to trading at smaller ATRs should take care of itself in position sizing. I mean, it should just roll right into the position sizing. But if you want to say, I only trade things that have an ATR of 3 or less, that's a great way to start, for sure.
Okay.
But you know, let's imagine that we traded this in Tesla, right? Let's say we got in and we're able to hold it the whole way up here, right? It gives you red light warnings before stuff is happening. This is when people just found out, hey, wait a minute, that $7,500 thing is going to be cut. And early people are already making their moves before the big announcement comes. And you can look at this almost across the board. Let's look at Palantir. Remember, it was after earnings right here, before this huge crash back down. Like, you could run it up and then it closed right at or right under could be your exit point. Then you had 2 closes underneath the 10 as an exit point before it even got worse. It came back later on, of course, but let's look at another example. Let's look at Meta. Right? You had some warning before this big sell-off came, right here, here, and here, and then it continued to go down, right? So what I'm saying is, when you guys know how to read the market, surprises can happen, but they generally let you know ahead of time something's not right. Generally ahead of time, something's not right. I even showed you, like, on the crashes, the big crashes in the past, the COVID crash, the 2008 crash, the 2000 crash. They let you know ahead of time something's not right here. But you have to be listening, right? You have to have a shirt on that says "Sit in cash and don't F up" when you start getting those notifications. Barry has a question. How do you go about managing risk of a massive decline? Think 2 ATRs after hours. If you do nothing, there's significant risk that the downtrend may continue the next day. Kind of like what I'm saying here, right? most of these significant moves give you warnings ahead of time. And if they do go against you, remember, by design, the position sizing is there to help you. If it goes against you, 2 ATRs, you might actually hit that maximum loss. But if that maximum loss is only 5% or 7% of your account, you're gonna be all right. You're gonna be all right. Let's see. Any other questions here? Johnny asks, do you always roll to secure profit? Instead of, say, selling 4 of the 10, you reduce risk both ways. I mean, if there are no good rolls with any open interest. So we had this conversation going on in the Discord the other day. And somebody was saying, rather than rolling, let's say you had 2 options. Rather than rolling, why not close one of them and let the other one run? Well, by rolling, I can still keep 180 deltas or 160 deltas. So let's say I bought it at 90. It went up to, or bought it at 80, it went up to 90. Now, if I hold those and roll them back to the 80 delta, I still have 160 deltas. Where if you are still holding the 90 delta, you just have 190 delta. Super complex topic. I understand. We're not ready for that yet in OVTLYR University. But the point is that you can do that. I just don't think it's the most advantageous thing to do. Michael asked, oh yeah, Mikey Mike, what's up?
When we're doing paper trading, I tried to ask this the other day. I think I kind of missed the mark on the way I phrased it. But if I'm staying out, I'm sitting in cash right now. Do the trading platforms allow you to trade on a fictitious market? Like, okay, my plan would keep me out right now in cash, but I want to practice trading. Can you still do that in paper trading, or is it like, no, this is the real market, and you don't have any money, you're playing with paper?
So most of the time, the brokers and paper trading that I've done in the past, it's been basically this is a simulated entry at this time, and so it's as if you're playing it on the video game at home, right? But I think Dave was going to say there are some that allow you to do like replays, which is really cool. Go ahead, Dave.
Okay.
Yeah. Thinkorswim on demand will let you do that. If you log into your live account and go up to the top right corner, you'll see an on demand button, and you can pick whatever date and time you want to start. So you can go back and say, hey, I want October of 2023. You can go back in time and
awesome. Okay.
And do that. It's not as clean. The on demand is a function they've not put a lot of work into. So you may get weird entries, you may get some weird signals, but yeah, you can go back and do it historically that way.
Okay, great.
Yeah, that's awesome. All right, listen, I got to run. I hope you guys appreciate, or not appreciate. I appreciate you guys. That's what I'm trying to say.
We appreciate you, Chris.
No. Don't appreciate me. I'm just a random guy on the internet. But I really appreciate you guys coming today, asking great questions, and I hope that we're all learning something together and getting better as we go. Listen, if you're ready to save time, make money, and start winning with less risk, head on over to OVTLYR.com. I mean, unless you want to just continue to lose and do all that terrible stuff that 90% of traders do. But if you want to be in the top 10%, you're in the right place. You guys are awesome. Thanks so much for coming. Have a great afternoon. We'll talk soon.